Welcome back. You're watching a Stock Watcher this week, and joining me to unpack your stock-related questions is Rowan Williams from Nitrogen Fund Managers. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, Rowan. It's been quite an interesting week there with a shift that we did see from Fed Chair Jerome Powell, and really also building on the cooler inflation print that we did see on Thursday. All around good news for the week?
Yes, I think, the end of the week certainly better than the start of the week. People are watching the Fed and, their next move very closely. It remains sort of a 50-50 call between a September cut and a November cut. With the latest in CPI print that we saw, cooling inflation to 3.1%, which was below sort of the forecast of 3.2%. It cuts expectations moving forward again towards September. We did see bond yields narrow quite nicely in the States. We've also seen the Rand off the back of that firm quite nicely. The South African bonds as well, firming nicely. So all in all, that provided sort of a late week push to the markets, and we saw a broad-based rally, particularly in SA Inc. stocks. Obviously, the stronger randing put a little bit of pressure on the Rand hedge stocks. And interesting, with the sort of expectation of a potential rate cut, we are seeing a bit of rotation out of some of those mega cap stocks into other parts of the market that haven't run as hard. So that also sort of overall tempered, I guess, the overall market reaction to what was, quite a positive outcome from the CPI and interest rate outlook. So quite a lot of underlying market movements within the movements.
Well, Rod, you talk about SA Inc. stocks, and it seems that there is more runway for upside on that. Where would the best buying opportunities be within the SA Inc. story?
So the quickest sort of beta, and where we have seen quite big moves, but I think they've moved to a level consolidating here, and there is the potential for another move up, is still in those interest rate sensitive stocks. So those are the banks, the life insurers, and the retailers. Those tend to move the most, but as I said, we did see quite a significant repricing. And I think what we're waiting to see is, the actual Fed rate cut. That will drive a rotation out of the developed markets, which have done very well year to date, the NASDAQ, the S&P, some of the other big markets, into EM stocks, of which South Africa would be one of the big beneficiaries, so emerging market equities. And I think once we see that, we will see a second leg up. And so the more liquid interest rate sensitive stocks, the banks are very liquid, the large life insurers, the like of Sanlam, Discovery, those Old Mutual, those are likely to benefit sort of quickly and see nice price moves up. The retailers as well. But then what you'd see is sort of secondary flow into some of the smaller companies, sort of the mid-cap stocks, and that may be where some of the value is still to be found, although we have been seeing the market looking quite broadly for value because we saw those quick moves. But some of the stocks are still very reasonably priced. I think they're getting to sort of high single-digit PEs. So what we are seeing is more of a rating improvement. So, and I think that's where we'll see prices move up. The short-term economic outlook won't change that much, but we are seeing improvements to the cost of capital and higher ratings. So there could be a second leg up in ratings. So we think it will be fairly broad-based actually in the SA space.
Well, zooming into the financial space at Capitec, there's a question here. Is Capitec a buy at current levels to keep over the short to medium term? Of course, they did come out with a trading update. Their numbers are still looking good, and actually, might I say, even above all the other banks.
Yeah, certainly above the other banks. So if you recall, the first half of last year, their comparable period. That was a reasonably tough period for them. They had higher credit loss ratios and somewhat muted activity. But this trading update that just came out this morning, 25 to 35% HEPS growth, that's substantial, way above the other banks, and does indicate that they're still on a strong growth trajectory and very much a growth bank story compared to the other banks, which are more of a value type story. So the rating is much higher because they are demonstrating earnings growth. But I think for the medium term, we expect the momentum in their business to continue. They've done a great job of introducing non-interest revenue services. So transactional services, value-added services like data, mobile data, payment-related services, the customers moving towards the app. And so some market participants have said they're more of a fintech company than purely a bank, and should also get a higher rating. But I think as we expect this inflow of foreign capital into emerging markets and South Africa, they will look at growth stocks and continue to give those very high ratings, which Capitec certainly fits the bill. So I think it is actually a good investment for the medium term because we expect their growth trajectory to continue.
Well, Rowan, nice segue into the next question as you're talking about fintech. There's a question here. There was hype about how fintech would disrupt the industry. Has that, the finance industry, has that played out? And which fintech players would be good investments at the moment?
Yeah, so I think there was a lot of hype around fintech, and often the truth sort of not as exciting as the hype and the expectation. So overall, I don't think there has been that as much disruption. What you are seeing is incumbent players that are able to implement fintech into their existing operations. All the banks are doing some element of it, I think. And in fact, we just mentioned Capitec is probably one of the best examples of that. Another good example is Pepkor, which has incorporated some fintech into their business. They do a lot on the mobile, the distribution of airtime, really using a fintech platform. Time Bank, which sits in African Rainbow Capital, is another good example. It does look quite exciting. Some of the payments players, you could argue, even something like
Capital Appreciation.
Yeah. So Capital Appreciation is probably a very good player. Altec as well has seen a very strong run-up in their share price. So that's another incumbent player that has a payments platform. But you mentioned Capital Appreciation. It's probably one of the better pure play players in fintech. We have mentioned it in the past. It's been one of our stock picks. We do have it in our portfolio. We think it's still very reasonable priced for the demand, for the potential demand in their underlying services. So the share has ticked up post results, but that's still an interesting one to look at. The other big one, I guess, worth mentioning is MTN, where it is a fairly substantial business in its own right, but really hasn't sort of got the rating and I guess the traction that people were hoping for. So a lot of expectation, but delivery not as sort of high as expectation. So and some of the mobile players in Africa can be considered, Safaricom, for example, can be considered somewhat of a fintech play as well. So you do have to look and see sort of how much actual delivery there is against expectation. So you have to be, I think, you're quite discerning in your stock picks.
All right. Well, I mean, talking about payments, because the second part of that question is your view on the likes of Visa and MasterCard.
Yeah, so those they juggernauts. They're massive players. They switch a very large percentage of the world's transactions. A lot more and more transactions are moving away from cash and towards credit cards. And so very established players, but we've looked at the share prices. The issue is they're very full. And we think a lot of the upside potential is already priced in. they sort of consolidated, the share prices have consolidated at these very high levels. MasterCard was looking somewhat attractive because it has come off its highest levels. But I think these major tech players are fairly full. And as I said, with the Fed rate cut, we might see rotation and actually away from some of these big players into other sectors and the emerging market equities. So that's probably where you're going to see more value. There's another interesting company called Mercado Libre, which is a e-commerce play in South America, but a big part of their business is actually payments and fintech. So that may be an interesting alternative to, say, an established player like Visa or MasterCard. Maybe Mercado Libre is a better way to pay payments, a sort of growth, but in emerging markets as opposed to developed markets.
All right. I hear you on that. And thank you for that gem there, Rowan. There's also been, just coming back to the JSE, Brait. I feel like it's quite a polarizing stock at the moment, considering its woes with New Look and also, I guess, the recovery story of Virgin Active there. That was quite slow for a while. And of course, now they're going through a recapitalization program. There's a rights issue, but also Ethos has unbundled its shareholding in Brait. Where do you stand on the fence when it comes to Brait?
Yeah, so Brait has been quite a complex investment case because there are quite a few moving parts. I mean, they've got some good local assets. So they did list Premier. Came with very good results, and the share price has had a strong run recently. So that is value in the overall Brait portfolio, although the biggest asset remains Virgin Active, which has had quite a challenging trading environment. It does look like in their latest update that things are improving.
Yeah.
I think the likes of load shedding, it's had an impact on many sort of businesses with a large store base or a retail base. So all the gyms would have to have had backup power and be running that backup power during load shedding. That's obviously looks like it's largely been dealt with, and it's a thing of the past, which would create a better operating environment. The South African consumer has been under pressure, but we do expect that to start to ease as we do see rate cuts both globally and in South Africa. We have seen South African inflation moderate. The strengthening rand is helping. The fuel price is coming down. So I think all of those things will create a better trading environment for Virgin Active, and it can improve from here. So I think a lot of it is in the share price in terms of the bad news. We have seen the share fairly weak. The restructuring also, I think, deals with the overhang that there was from the convertible bond. And it's been moved out for another 3 years, which gives them, I think, a reasonable amount of time to manage their portfolio for value and create value for shareholders. We have seen some of the leading shareholders also buying shares at these levels, Titan, Christo Visa's holding entities. So I think that's a vote of confidence. So I think at around R1.10, where the share price is right now, it does demonstrate quite a lot of value. The unbundling by Ethos Capital, I think, also improves the share liquidity, and then also sort of removes a potential overhang in terms of, what was Ethos going to do with their shareholding in Brait. So I think all of these are quite positive developments, plus the complex Brait and Ethos Capital. So they are actually looking quite interesting at these levels. And you're getting assets, I think, that are sort of, quite sort of stressed prices, but certainly have the potential for improvement from here.
Around this week, there have also been a lot of questions on gold. What would you say, what would your investment case be for gold? And obviously, there have been questions on gold and Harmony Gold and gold fields. Where would you be placing your money on gold at this point?
Yeah, so gold's been incredibly resilient, and notwithstanding a high inflation environment and a high interest rate environment, which sort of increased the costs of holding the physical because there's no no yield from gold as an asset, it's actually been quite resilient. And now that we are seeing the potential, inflation moderating, potential for rate cuts, that gold has been quite firm. That is obviously good for the gold miners. They've performed actually really well, notwithstanding, the rand has strengthened. They are rand hedge stocks, but we think they're fairly full. There's been a lot of strong performance, and Harmony in particular, he also had a very strong run, very high rating. For example, Goldfields just indicates that there's still quite a lot of operational risk around these gold mines, and difficulties in some of their South American mines. So we much prefer real businesses that provide a service that real people use, that sort of has a relevance. Whereas we would see gold as somewhat more speculative, but it has been resilient as a store of value. We just think it's very full at these levels. But I think there are gold bugs out there. People like gold, and it will continue to be a relevant investment and asset class for people to consider.
All right. Well, what else, or what are you considering today? Your stock pick, Rowan?
So our stock pick is Omnia, which is very much a South African industrial asset. Their main business is chemicals, fertilizers, and explosives. And what we saw was quite a strong and resilient operating result, notwithstanding a very tough operating environment. They've managed to sort of stabilize the fertilizer business. The explosives business, somewhat exposed to the mining cycle, but that looks resilient. They're doing a lot of work in international markets, so there looks like there's really good growth. We did see the share sort of re-rate on their update, and importantly, it's still come a large special dividend. So between the ordinary dividend and the special dividend, you're going to get about 10% of the share price back. So your entry price X the dividend is still around 64 Rand, or maybe a little bit lower. And I think it is teed up for good growth and a re-rating, along as we sort of gave an investment thesis earlier in terms of SA Inc. stocks. So you're getting the benefit of both of those. And we should see reasonable performance from this base going forward over the next 12 months.
Well, thank you so much for your time and for your analysis today, Rowan. Much appreciated. That was Rowan Williams from Nitrogen Fund Managers.